The markets in last 1 month, they've given you flat returns, which is that Nifty has just hugged on to the flat line and we are up by about 1.5% for last 1 month. Now superimpose this with last 3 months. Then hold your breath here, which is that in last 3 months, Nifty has given you double-digit returns of 15%. This is very smart for Nifty in last 3 months. But in last 1 month, the return is only 1% plus, which means that in last 1 month for a Nifty watcher, the returns have been missing. And that could be a function of global cues, churn at the top, global volatility. But the bottom line here is that even though optically this market is at an all-time high, it is showing signs of what could be called as consolidation or a fatigue. So if you look at the market from the lens of Nifty, it is not a market which is showing signs of too much of momentum. Because momentum, what it was, technical setup, let's say in the month of June and July, was far more powerful than what we've seen in the month of August, which means markets are telling you that they want to either hit a pause button or they want to move into some kind of a patch of consolidation. And I think that is aptly evident in the way how the small and the mid cap indices are also moving. So when it comes to the global market, we are just moving in tandem. 1 week they are up, 1 week they are down. But the bottom line here is that optically markets are at an all-time high, but technically this market, like I said last Friday, I think it lacks that real inertia, so to speak, which would really take it to the next level. So 25,000 in and around, you settle, great number to settle with. 25,000 to 26,000 or 25,000 to 27,000, I think that's not going to come in a hurry. That is what indicators are indicating.
Okay, that's how we're looking at the markets from sort of a 1 month perspective. But those are the indices over the last 1 week, and that's how we performed in terms of individual sectors. Clearly, IT was your standout. You had pharma, that defensive trade really played out multiple days in the week gone by, and real estate as well got a nice shot in the arm. For the frontline index, a gain of about 1.7%. And if we compare ourselves to the rest of the globe, while we may have underperformed the Hong Kong markets, we still did witness our third straight week of advances, third month on the trot as well. And it's been the longest buying streak out of the last 12 sessions. And even looking at the rest of the globe, it has been a decent outperformance compared to what we witnessed on Wall Street at least. And more importantly, Nikunj, you've also seen the broader markets that have been participating. So yes, you're talking about us being in for a patch of consolidation, but how does an investor approach the market at a time like this?
See, let me identify some trends here. Trend number one in my book is that there seems to be, and I'm going to be repetitive here if I say that, the crazy move in some of the PSUs is certainly coming to a stall, whether it is defense, railways, even for that matter, PSU banks. None of the PSU banks, at least the one which matter, are anywhere close to new high. So that's one trend which is visible. Second, please avoid the, craziness and the mania which is happening in the IPO market. Now, whether it is the SME market or whether it is in the main board market or the big market. Why? Because crazy numbers are coming out in terms of subscription, crazy listings are happening. I mean, just think about Ola, a very well traded IPO. At 70 rupees, it did not find any takers. And then within a week, it went from 70 to 150. Similarly, there's another IPO which is coming, I think Premier Solar Energy, where the subscription numbers were as high as what a Tata Group company in a sense got. So for me, that is one pocket of red flag, so to speak. The third is that we are in an environment of interest rates which both locally and globally are all set to come lower. And when that typically happens in the first leg, NBFCs and large wholesale banks, they tend to outperform. So I think more than private banks, I think wholesale banks and NBFCs, they could be getting ready for some kind of outperformance. And fourth is that festival season buzz has already started. Auto dispatch numbers don't look all that impressive. Let's wait for some more companies to get a sense as to which way festival demand is moving, because markets are expecting that courtesy good monsoon, we could be in for a good revival in rural demand and good revival in festival demand. So that's the moving part, which becomes the fourth part for me in my book. Where I'm confused and I've got it completely wrong, and I must admit it, is IT. IT index is at an all-time high, and with this kind of a data point, I'm surprised that why would anybody like to buy businesses which are growing at 8 to 9%, not even 8 to 9%, 7 to 8% and trading at P multiples of 30 plus. So I refuse to say that IT is value, but markets are markets.
Yeah, markets are markets. They are the ones which are still holding up. And yeah, it was actually IT which was one of the key contributors to last week's rally. The index itself was up a good 4%. And I'm not even talking about specific movers like an LTTS and others, what they did individually. Pharma, realty, metals, they're all really playing a comeback. And like Nikunj said, you know, it's PSU banks. That index was lower by about 0.5%. And Nifty Bank, 0.7% higher. So that underperformance vis-a-vis what some of the individual sectors, what the benchmark Nifty has been doing, that clearly is quite contrasting and stark. But yeah, you had macro data as well come out, the GDP numbers at 6.7, GVA though for the June quarter at 6.8. Having said that, a lot of global forecasters have already been upgrading the full year GDP numbers well above that 7% mark.
So whether it's Goldman Sachs or UBS or Morgan Stanley, I think these numbers are in line with estimates. So optically, it may appear, oh, 7% plus print has become sub 7%, and does that mean that India is slowing down? No, sir. There's a base effect, and there is a very large cyclicality which I think is at play. The moving parts now would be that export, which was slightly rusty in the last GDP print, is showing signs of growth. Now, will exports continue to grow at a time when the global forecast for economies is down? That's one. Second, there is a reasonable assumption by every economist that there would be a 4 to 5% uptick in the household consumption or the domestic consumption, which is a function of how monsoon ultimately settles. So that's the second moving part. Third moving part is that while government capex is strong, private capex is yet to pick up, and there is no evidence, at least in terms of the data what we have tells you that private capex will come back in a hurry, or will come back in a big bang manner in the second half of this year. So that's the third cross. So while these numbers may not really surprise the market, it may not disappoint the market, but the assumptions for full year now, they need to be calibrated in the light of the 4 points which I said in terms of where the economy is going to move. Unfortunately for the economy, there is no large inertia which will really generate upside momentum, or there is nothing which really could be called as a trend which is going to be great, because you've just got everything you wanted. Elections are over, budget is over, monsoon has been great, rural economy is recovered, Fed has cut rates. So now, more than surprises, you could be in for some disappointment on the macro front, at least for the second half of this year.